Hey guys, welcome back to the video. I'm Luke, an ACA qualified accountant, having passed all of my ACA exams at the first attempt. And in today's video, we're going to discuss a critical accounting fundamentals topic, which is DEADCLIC. In my opinion, DEADCLIC is the most important bit of theory that you need to master before you walk into your accounting fundamentals exam. It applies not just in the multi-choice questions, but also when you're doing your long-form scenario-based question. It's absolutely fundamental. So we're going to run through a couple of slides here to help explain the concept in a little bit of depth. So yeah, let's get into it. So when you're learning double entry bookkeeping, one of the biggest challenges I found was remembering which type of transactions for specific accounts impact the debit side and which impact the credit side. And that's where the acronym DEADCLIC really helps, because it gives you a very simple rule to follow. We split it into two parts. DEAD stands for debit, expenses, assets, and drawings. These accounts are all debited when they increase in value. So for example, when the business has seen an increase in assets, we debit the assets account in the nominal ledger. If you say pay for electricity, buy a delivery van, or the business owner takes money out for personal use, those are all increases to expenses, assets, or drawings. So they go on the debit side. But one important thing I want to mention is that any decreases to expenses, assets, and drawings do go on the credit side. So increases to expenses, assets, or drawings are recognised on the debit side, whereas decreases to expenses, assets, or drawings go on the credit side. Then we have CLIC, which stands for liabilities, income, capital. So credit, liabilities, income, capital, excuse me. So these accounts are credited when they increase in value. So if the business takes out a loan, it makes a sale, or the owner invests money into the business, those transactions will all be recorded on the credit side because these accounts are increasing. So increases in credit if liabilities, income, or capital goes up. But again, keep in mind, if one of these accounts decreases, then the entry doesn't go on the credit side, it will go on the debit side. So for example, if a business repays part of a loan, the liability amount will be decreasing, so you'll need to debit the liability account. So to summarise this slide, DEADCLIC gives you a really quick and easy way to help decide how to record the transactions you come across during the course of your studying. If you can master DEADCLIC, and I really encourage you to master DEADCLIC, you will be well on your way to mastering the double entry part of the syllabus. So this slide brings everything together and shows you how to apply the DEADCLIC rule. You make a debit entry in an account when there's an increase in an asset, like for example when office furniture is acquired, or there's an increase in an expense amount, such as paying for stationery, or the owner has made a drawing. But you also make a debit entry when there's a decrease in liabilities, or there's a reduction in income, or a reduction in capital. So you debit an account when there's been an increase in expenses, assets, drawings, or there's been a decrease in liabilities, income, or capital. On the other side, you make a credit entry when there's been an increase in income, like for example, the business has made a sale. There's been an increase in a liability, such as the business has bought goods on credit, or there's been an increase in capital. But you also make a credit entry when an asset account decreases. So for example, if the business has made a cash payment, or if the expense account decreases, or the drawings account decreases. So by following these four rules in your exam that I set out on this slide, and by remembering DEADCLIC, you will have a really solid grounding to help you decide how to record different types of transactions accurately in your ledger accounts. Cool, let's take a look at an exam style question here. Which of the following is most likely to result in a decrease on the credit side of a journal entry? Your options are A, an increase in capital, B, a reduction in income, C, an increase in bank loans outstanding, or D, an increase in non-current assets. So the correct answer here is B, a reduction in income. And the reason why is because income accounts typically carry a credit balance. So when the income amount is decreasing, we record a debit. And that debit reduces the credit side of the income account. That's what the question is testing, basically. Your understanding of how income reductions affect double entry. So let's look at the other options and see why they're incorrect. Option A is an increase in capital. That's a credit entry. So an increase in a business's capital would lead to an increase on the credit side. It wouldn't reduce the credit side of a journal. Option C, increase in bank loans. That's a liability, and liabilities are credited when they increase. So again, this would increase the credit side of a journal entry, it wouldn't decrease it. And option D, an increase in non-current assets. This would be a debit entry, so it has no impact on the credit side of a journal. So yeah, option B is the only option here that actually leads to a reduction on the credit side of a journal entry. It's cool. That's everything I wanted to discuss in this video. That's DEADCLIC in a nutshell. Hopefully that was helpful. If you do like the video, please smash the like button and consider subscribing. See you guys in the next one.